Hey, everybody, welcome to Technically Trading with Robert Roy. I hope you're having a fantastic day. As we get started here, keep in mind that everything we look at is for education. Nothing's meant to be advice or recommendations. If you find something that you like, anything, make sure it fits your own personal risk profile and risk tolerance. All right. So, boy, it's great to be here. I want to thank Tradier for putting this on. I think this is a fantastic opportunity for us to spend a little bit of time together and go through some of the things that I personally do in the market day in and day out, which is how I look at the technicals. And I thought the best way to start the very first show off is to go through the way that I look at technical analysis, the things that I do as a big picture. And this way, as the first show we're doing here on the hub, we'll be able to point people back to that show when they say, I don't understand how you utilize Fibonacci, which is my key indicator. How do you utilize Fibonacci? How do I learn to draw them? What do I do next? This will at least have a place to point you back. And then the whole goal of this is to go through the technicals then of that along the way. So if you're looking at my screen, you see we've got a chart up here of Apple right now. And Apple, great stock, very big blue chip stock. On this screen right now, there's nothing as far as lines drawn on the chart yet. We're going to do that together. But I've got moving averages on the top of the chart. They are, there's 4 of them up there, 2 primaries. The green and the pink are the 8 and the 21. You're welcome to use any setting you use. This is the ones that I used. I've gone back and back tested 4.5 million days of moving average crosses with different cross settings, and 8 and 21 gave me the best setups. So I use 8 and 21. They happen to be Fibonacci numbers as well. And as everything that I do revolves around fibs. So the brown line is a 55. I do not use a 50. The blue line, it's very faint. It is a 5 moving average. It is really for one exit on one very specific trade type that we do. So I don't use it very often. It's really only on a swing trade that we use it, but it's left on there just to help with fast moving trends. Down in the center, we've got DMI plus and minus with the ADX, and we'll get into a little bit what that is at some point. CCI, I only have one pattern I look for on there, and that's extremely overbought and oversold. That's my oscillator. I don't use MACD and stochastics, RSI. Nothing wrong with them. I just like the way that CCI works for me. My primary indicators are Fibonacci along with 8 and 21 moving average. I can make almost all of my decisions from that after the stock has already been identified, meaning I have one other template that I work off of, which has some different indicators on it. So I've got the same chart, but no technicals on there, no moving averages, no parabolic SAR, nothing on top. I want nothing messing with the chart. And what I have found as a coach, and I've been teaching people since 1999, trading since 1997. What I found as a coach is when you start putting more indicators on the screen, it starts to help you form opinions that may not be right. So let the first opinion be what the stock itself is doing, not what somebody else's indicators are telling you it's doing. As much as I love moving averages, I don't use moving averages on it either. In the middle is probably one of the most important components of what we do, and that is Wilder's average true range. Now, I use Wilder's instead of average true range. The difference is this. Wilder's average true range, or let's go this way. Average true range is how much the stock moves intraday from high to low. And it basically works off of yesterday's prices. Wilder's takes into account today's open. Some will differ. There's difference of opinions. If you like average true range versus Wilder's, that's fine. It doesn't matter to me. Wilder's is the one that I focus on because if there's a gap today, it may not be normal that it gapped $8 up or down, but I want to know about that. I want that built into what I'm looking to trade today. So this says that we move about $5 per share over the course of 13 days, the previous 13 days. You see in parentheses down here, bottom right, that it says a 13 equals 5.0311. So that's $5.03 basically. So if you are looking to place a trade, and let's say we're doing a day trade, and your goal is to get in that trade and pick up $11 today. You want to get all the way up to the resistance level from where it is. The stock only moves 5 a day on average. That doesn't mean it can't move more from low to high for the day. It certainly can. But the likelihood is a lot less that you're going to get a $10 move today or an $11 or a $15 move when the normal movement over the last 13 days has only been 5. And that's an average of 5. You can go back and look and you can see the line, and we were down lower than that. Not long ago, we were 383. Just a little bit before that, we were at 601. So the average is about $5 a day that it moves. So when I look for candidates to put on my list, and I said this before, once you've identified the right candidate, I use the primary indicators. I need wildest average true range to help me identify a candidate to go on my list. Now, in Omega Charts, which is the software that I use, it's a software that we use at wealthbuildershq.com. Any software, I don't care where you use it and what software you're using. It could be what you have on Tradier, if those are available, or any other platform that you're using. That's fine. I like to use it to help me identify. One of the things that are important to me are filters. I want to build out a filter that identifies candidates that fit a certain criteria. And we're going to do that in one of our lessons, just not today. So I'll put in price, volume, possibly beta, weekly optionable, variable things that, or various things that I need day in and day out to help me make a trading decision of, is this yay or nay? Is this good, bad, or indifferent? And bottom line for me is I want to see at least a $5 move intraday. Now, remember, if the stock opens up, let's say, let's just grab a line and we'll draw it out, right? Let's just say whatever this level is, 240, close enough, okay? $240. The stock opens there. That's where it opened. If we had a wick come on down and that wick brings us down, let's say 237, and then we have the high comes up to 244, right? Well, 237 to 244, that is the intraday move. It's not off of where it opened. It's from wick to wick, high to low is what we're looking at there. So we want to make sure that just because there's $5 high to low, that doesn't mean you're going to get $5. If you bounced off support, or let's say you opened at support, you broke support a little bit, and it came down $1 below, and now it bounces. That $1 below, that's part of your $5 move. So you're only looking to get back to support plus $4 more. And that $4 is up to the high. That may not happen right away. It may move up $1, pull back, then go higher. It's overall from the low to the high of the day. Okay, so the extremities or the wicks is where it measures off of. And again, Wilders takes into account the open of the day. You don't need too much of the technical on it. Just know that you might want to consider adding an indicator like this to your list to say, I really need to have a minimum of this much in my trading. Now, if your goal is to pick up a stock or an option, and I am definitely an options trader with stock on the side, but if my goal is to pick up 50 cents on a trade, do I need $5? The answer is probably not. I could probably get away with $2. But realistically, anything under $3 a day for me is very difficult to accept as a viable amount. I need more movement than that. There's just not enough room, in my opinion, for me to make any money. Now, the very bottom of the page is volume. So volume is an indicator that I want to see at least 1 million shares traded a day. And that's fairly easy in this environment. It's not something that's complicated to come up with at all. And I have a moving average on here, a simple moving average of 21. All the other moving averages I mentioned are on the previous screen, 5, 8, 21, and 55 are all exponential. For me, anything above 55 would become simple. Anything 55 or lower is an exponential on the chart. On the moving average, I am not trying to weight anything, put more emphasis on today versus tomorrow, which is what exponential does. More weight today, a little bit less yesterday, a little bit less the day before. I want weight on volume to be the same across all of them. So this is a simple moving average. So you see it says moving average, moving AVG, and then 21. If we go back to my template number 2, and you look, you'll see right here, we've actually modified them. So we've changed it here. But 5 EMA, it normally would just say 5. It would say moving average X for exponential. We've changed it so it says EMA as our label. It's a little bit shorter too, fits better on the top of the screen. But you can see what each of the labels are. It tells us what lines we're looking for in there, okay? So Fibonacci, ideally when I draw it, I want to draw it on a chart that has no indicators on it. Forget what's there. Just get rid of everything that's out there as far as indicators go and have nothing else on the screen. And I want to go back and I want to get to about 6 months of time further back. So we go into August, a little bit further back. That's about 6 months that we've got there, okay, of time. And what I'm looking for is I am looking for stocks that have a valley and a peak. And here's the rule, and write this down if you've not heard this way before. On Fibonacci, I am looking for the largest directional move closest to the right side of the chart. But I need to have a clear directional move. What does that mean? I need swing lows and swing highs in there. What is a swing low and a swing high? If we identified this candle right here, that candle right there gave us a high. The next candle gave us a higher high. The one after that gave us a lower high. So what does that represent? We had a high, a higher high, and now a lower high. That middle candle is a swing high candle. And we can count on that as a place to potentially draw a Fibonacci from. If we work our way down, we've got a fairly straight move down here. This was kind of sideways. Nice drop in there. This right here, it bounced a little, but not really enough for me. And I'll show you what I mean in a moment of not enough. Not really enough for me to say, let's draw off of that. And I'll show you why in a moment. And then we've continued down. So now what happened? I had a low yesterday. I have a higher low today, right? And I had a low here. I had a lower low here and a higher high here. So actually, we do have a V bottom on this that we could potentially draw off. It still hasn't bounced enough for me to say, let's go ahead and draw them there. And again, you'll understand that when we go and draw them in there now. So I'm going to grab a Fibonacci for us. Now the Fibonacci is a standard tool on most trading platforms. Most softwares have Fibonacci on them. I'm going to grab this Fibonacci right here. And all it is if I just click the mouse here and hold it down and drag it out, you're going to see that the top blue line, which is number 1, 283.45, every other line is being drawn automatically in there. My mouse is the second blue line, which is the 0. All right. If I let it go, it'll snap a Fibonacci on there. Now, it's not in where we want it, but that was just for a reference point. So if I come here and say, okay, let's grab the highest high. And then we came down, we had a nice little bounce take place here. Was that bounce big enough? We're going to move down. If you watch what happens, when I move the mouse down, watch what happens when I get to the end of the wick. You're going to see the line jump. When I get close to it, it's going to jump to it because you want to draw off of wicks, not off of bodies. See a jump? Watch, we'll do it again. Boom. It jumped to that line. There are different opinions on how to draw Fibonacci. This is how it was taught to me by my mentor back in 1997. I have been doing it this way ever since. I have a very good friend of mine, a coach that actually teaches for wealth builders. His name is Dale Zamzo. He draws off of the bodies. Doesn't make him wrong. It's just the way that his system works, the way that his indicators work, the way his trading works is off of the bodies. I like the wicks a little bit better. Now, I may actually have been wrong here. So I am looking for a move down. This is the largest directional move in the last 6 months, closest to the right side of the chart. Because all of this, we had this V bottom here. So if we draw a fib off of this, we had a V from here up to here. It's clear to see that what we have on the right is bigger. Okay, that's number 1. So, but we don't get rid of the old fib. I've got another one that's back here. It's not great, but it's okay. I've got another one in there. And then I have one back in here as well. Okay, so all of these are various Fibonacci's, but they have been violated. And we'll talk about violated at another time. Right now, we're just worried about drawing the new fib. So largest directional move closest to the right side of the chart. We've got that. Now let's look at the different Fibonacci levels that we've got on there. I'm going to zoom it in so we can see it better. Right? If you're familiar with Fibonacci, you will be familiar with the 618, with the 0.5, with the 0.382, and with the 0.236. You'll be very familiar with those levels. Right? The 0 and the 1 is where we started. The 0 is 100% of the move. So it started here at 1, went all the way down to 100, which is labeled as 0. If we get a bounce off of this level and it bounces up to the first line, we bounced 0.236% of the overall move. So if the move was $10 and it bounced 23.6%, that's $2.36 of the $10 move, 23.6%. Right? If it bounced halfway to the 50, the 0.5, If we dropped 10 and we came back 5, it moved $5 back up, right? So it is a retracement level, and that's what Fibonacci's are. They're retracement levels. Now, I want you to understand, and if you haven't done the research, please do. Please go in and look, because there are too many times I see people very quick to judge and say, yeah, fibs are not important. They don't really work. There's a lot of lines. Sooner or later, it's got to hit a line. Yeah, I guess. Okay. But Fibonacci is a support and resistance level based on harmonics, based on human nature, based on human emotion. These lines were determined a long time ago. If you do the research, you'll see it. Everything in the universe is based on Fibonacci. The structure of a flower or a tree, the branches of a tree, how they spread out, is a Fibonacci. A conch shell, that spiral shell, the shape of your ear is a Fibonacci spiral. One of my favorite Fibonacci spirals, there's a woman that has her head down. She's at a beach, long hair, soaking wet, and it was a video, and she snaps her head back, and her hair snaps back. And in the video, they freeze it, as the water is up there, they freeze it, and they put the Fibonacci circle on there. If you've ever seen Medicine Man, where the guy's standing with his arms out and his legs out, the distance from your fingertips to the floor versus your fingertips to the top of your head, center of your nose to the center of your eyes, to your ears, your height of your head to your eyes, to your nose, to your mouth, to your chin, all Fibonacci levels. If you've ever looked at an individual and said, wow, that's a very attractive person, right? Very handsome man, very attractive woman. More than likely, facially features, and there are scanners you can get on your phone for free, and you can take a picture of your face, and it will, tell you what you are. And we did it with my nieces, and they were 82 and 85, and they're like, "Come on, Uncle Rob, you do it." I'm like, "No, I don't need to do that. I don't need to see where I'm at. I'm not thinking this is going to give us a really great number, so I'm okay." But art, medicine, outer space, everything in the universe, your DNA is made up of a perfect 0.618 and negative 1.618, or a 1.618 rather, Fibonacci level, with the major and minor spirals of your DNA are those numbers. Everything is Fibonacci related. Well, if it's that important in the universe, that's why I use it in my trading. Now, that doesn't mean you have to, right? I do believe if you stick with me and you learn this, you are going to add Fibonacci to your arsenal. I don't believe there to be a better indicator than it, but one of the coaches that teach for us, his name is Brandon. He uses RSI. It is his favorite indicator. I don't have good results with RSI. It just doesn't work well for me personally. Okay. So what I am looking for when I draw this fib is I want to see a bounce, ideally that it came off of that swing low in this case. I want to see a bounce that gets up near that 236. So we had approximately a 23.6% retracement take place on the way up into this position. That is what works for me. Now, I gave you the numbers before: 618, 50, 382, and 236. I didn't give you this number, 764. And if you've seen it and you're scratching your head, or you're looking at some notes saying, I don't remember ever seeing a 764, you didn't, right? It's 786. 764 is my number. There's a reason I did it. Again, I don't do anything without testing. I went back and tested tens of thousands of charts and found that if I converted this 764 from the 786, it gave me a perfect confluence of 236 away here, 236 away here, and it just gives me a better result in my trade setups. I've got 7 different trade setups I trade off of Fibonacci. Having that level there at that level is a more accurate level for me. Doesn't mean you have to use it. It's just the way that I do. I also automatically draw extensions in here. And those extensions work their way down that I get, in this case, I get a negative 272, a negative 382, a negative 618, and a negative 1. So basically, I've extended or doubled whatever the distance is of my fib from here to here, from 1 to 0. It's the same distance from 0 down to negative 1, right? I have the same pattern inside of there. I've doubled, or what I call stacked, the Fibonacci on top of each other. That gives us an opportunity to have breakouts and give us retest levels of places we've not been before. We know on the way down, when this stock ran down in here, and now we come back up, we could see that it's retesting. We know that level is there as a ceiling. We now have some supports down below as well. All right. So once we have this on our chart, now we have some decisions to make. Does this make sense or not? I'm going to switch back over after we have the fibs drawn on here. I'm going to switch back over, and I'm going to go into a chart that has moving averages on it. And very simply put, for me, would be, okay, if I am looking at Apple right now, it's end of day, markets closed. This is tomorrow's chart, ready for tomorrow's open. It's a clean chart from close of day. And I'm looking at this. We are very close to a Fibonacci level, very close to a line. I love that it's sitting down there. So what would it take for me to want to take this trade? Well, first thing is, what's the market itself doing? What is the S&P 500 doing? If the S&P 500 is bouncing, if it's moving up, if it's bullish, you have to ask yourself the question, do you want to take a bearish trade? I'm not saying you don't. And if you're more experienced, then yes, you probably should consider taking trades that go against the direction of the market. But if you're a newer trader, go and do the research. 70 to 80% of all trades move in the direction of the S&P. The very first thing you should do as a newer trader is stop trading against the grain of the market. If the market is bullish, trade bullish stocks. If the market's bearish, trade bearish stocks. Don't go out after this trying to trade against what's happening if you don't have the experience to do it yet. Especially if you feel that you're the type of person that goes, oh, I'll wait one more candle to hit my stop, but I'll wait one more candle. Now it's moved too far. If it just goes back to where it was on the last candle, then I'll get out, and it keeps going against you. Instead, trade the direction of the overall market. So the S&P 500, if it's bullish, trade bullish. If it's bearish, then trade bearish. If you get if you are a more experienced trader and you get a day that the market is, let's say the market's been bullish, and then just a few days ago, we had that big gap and go to the downside over Greenland and tariffs and all that fun stuff, right? Well, could you trade that bearish? Well, I did. Why wouldn't I? I am an experienced trader. I've done tens of thousands of trades since 1997. So yes, as a newer trader, you should trade it too on paper, non-funded trades. You're learning Fibonacci. Don't jump in and throw money at this. Go and do non-funded trades. Get into your practice platform and start placing trades. Non-funded, so this way you can learn. You've got some experience. You learn how to hit the buttons, and you know how to set your targets and your stops based on what you're doing, right? And you understand how to do it in your software platform. So what am I looking for now? I would look at this and say, where do I want to see it go? Well, we're in a bearish market. So if I can get a bearish move on the S&P 500, here's what I want to see happen. I'd love to see us break this 246.75. I'd love to see a break down below there. If we can, 243 would be my target. Well, I don't have a whole lot of room on that one. And that's why I don't normally trade Apple. I don't have a whole lot of room on that one. So this is probably not one that I'm going to choose as a trade. For drawing the fibs, we followed all of the rules and everything is fine. Instead, for me, I'm probably going to go ahead and, let's say, go and bring up CrowdStrike. All right, let's give it a little bit more time. Now, this is a much older fib. Right? So this Fibonacci starts way back here, runs up to that swing high, pull back to the 236. Beautiful. Here are some things that you want to check once you draw a Fibonacci. The very first thing is this. You want to see the distance between two particular lines, the 0.5 and the 0.618, which are these lines right here. You can't see them off screen, but I need to do that just to get it big enough for you to see. But it's 0.618 and 0.5, okay, right here. So I want to see 442.5, we'll call it, and 455. I need that distance to be a minimum, and I mean a bare minimum of $3, which is not enough for me. Why $3? You have a support. Stock bounces off support. Let's say the support is at 100. And you have resistance at 103. That's your next line, because that's what that is. This, if we're bouncing off of this purple line, the 618, that's my next target right there. And look what that candle did. It bounced off that line and went all the way up to resistance and failed off of it. So we would have hit our target and been done with that trade. So what happened then? What transpired? What took place? Well, I want to see if I get the bounce off of that line and it's 100 and I wait for it to get to, say, 101. It's $1 away, and that's where I enter into the trade. Okay, fine. Where's my target? Well, if my resistance is at 103, where am I going to make it? 102? So I get in at 101, I get out at 102. I mean, is the juice worth the squeeze? Is it worth the work, the effort, the potential risk of going against you to just have $1 potential? Because keep in mind, just because there's $8 move from support to resistance doesn't mean you're getting it all. Doesn't mean you're going to get it all, right? That's a goal, but there's no guarantee that you're picking all of that money up, right? The guarantee is the movement potential is there. That's the only guarantee. And I don't hardly ever get it all. I never get it all, actually. I never get from support to resistance. I never get that full amount because I needed to bounce off support and I'm out before resistance. We've got one of the programs that I teach, one of the rules we teach in our power option plays is when it bounces off of support on prices of stocks that are between 100 and 1,000, let's say, we're going to need at least $1 bounce off of that support level. And that's a bare minimum for us. You can use more. I probably wouldn't want to use less because less could be nothing more than a head fake in there. So we pull down, we bounce off that 442.60 level, and we start to move up. Where is my resistance? Well, my target on a stock like this is usually about the same thing, $1 to $2 below my resistance level. That is normally where my target is. I have preset numbers of how we go ahead and place these trades, right? And we did 350 trades last year and I just ran the numbers last night because we did a training on it last evening, and we had an 82% win rate on our stocks, on our positions. Now, it doesn't mean we could have won and it made a penny, right? But it was a positive trade on that position, okay? So we had a really high win rate this last year. The year before, I think we did like 79%. So we're still in the same ballpark. But by having those in there and then setting a stop just down below, that right there is what I need to do. So I need to go into this trade saying I want to have a minimum of a $2 reward for every $1 of risk I'm willing to take. So if I can bounce off of this 442.59, and let's say that I get in, let's just draw some lines on there. So let's use easy numbers here. We're going to use 443.60. Right? And I'm going to change that number over. Change this to 443.6, right? So we said an actual dollar, right? I'm going to change this to green, which will indicate our entry, and that's the entry into the trade. If I put a target up here, I'm going to change that target as well to green. Let's change it to a different color. Let's go with this greenish bluish type color, okay? And we're going to go with $2 below, so 453. It's close enough for us, right? So 453, that's my target. Well, where's my stop? My stop is going to be down here, 27, 37, 15. I'm about $4 below this level. So right about 438 is where my stop is going to be. All right, so let's change the stop to red. A nice red color going there. We'll go to 438. And now I have the trade set up and it's in place. Why did I do this? How much can I make? If I get in at 440, let's just say it's 444, not even 443.60, 444. All right, let's just make it easy math. We get in at 444, we've got to run up to 453. That's a $9 potential. Will you get all of it? Not necessarily. Here we are, we get in the trade at 9:35, 9:40 in the morning, and it runs not $9, but it goes $6 in the next 15 minutes and starts to roll over. Am I going to wait till the end of the day? No, I'm out. I am out of that trade. I am done, right? I have the potential for 9, but I'm going to lock that profit in and walk away based on a series of rules. I don't do it just half-heartedly. There are patterns I look for that will say, let's pull out of this trade. Well, how much risk do I have? So I got $9 of profit. How much risk? I got 38 to 44. I have $6 of risk in, no, not 6, 2, yeah, 4 and, yeah, 38, $6. So I have $6 of risk. So do I have $2 of reward for every $1 of risk? If I'm making $9, the most I can risk is $4.50, right? And right now I'm risking $6. So this trade doesn't work out to be one that will work for me. Fibonacci tells us all of that. Well, Rob, how do we know the accuracy of it? Right. Well, if you just look at what's going on right now inside of here. Watch the chart. Let me go back over to template number 1. It'll be easier. Get rid of the moving averages. We just drew this. Well, this is CrowdStrike. But if you look at this chart, look at the lines. I drew from where we started to where it ended. When we pulled back, we stopped at this very first line, the 236. By the way, write this down. 236 has a meaning to it. It is called hesitation. 236 is a hesitation level. Doesn't mean it's going to bounce. Doesn't mean it's going to break, but it tends to slow down. That's our hesitation level. We pulled back to that level. We hesitated. We came down to the next level. We bounced. Where did we close? Right at the next level. We bounced. We pulled back. We vacillated in there. We closed near this level again. For 4 days in a row, we played on that line, on that zero line. We came back to the next level, came back here again. We went to this line, then this, all inside of here, right? We went back down to here, 2 days of wicks down there, right in here again. We gapped up right to the line. But you didn't hit the line on that one, Rob. Guys, Fibonacci is support and resistance. You will not hit it on every single pullback, on every single breakout. You won't, right? You're going to have to treat this just like any other support and resistance, where you're going to be in the area, not necessarily exactly to the penny where you bounce off of a level. But you could see it. Look at in here. We pulled back. We went right to it. Came back down here again. 5 or 7 days right in there. Right to that one. Right to this line. 3 days there. Right here. A little bit lower on that one. We closed right there. 4 days, 5, 6 days in a row we're there. We close here, back to here, and we bounce. Right? And this does it over and over and over and over and over again. Okay? The opportunity is there. The opportunity is there if you can find it. Now it just comes down to finding the right trades. Right? If I was willing to take less risk on this position and not get out at 338, but maybe get out at 40, maybe get out at 440 instead of 438, now I would only have $4 worth of risk, $9 worth of profit. This becomes a home run. So if I change the stop over to 440, a little bit tight for me, just so you get to understand the concept. I've got $9 of profit potential, $4 of risk. This is a yes, I'm going to do this trade if the trade sets up for me. Right? If we can get a pullback and get that set up in there. Right? This is a 5-minute chart of CrowdStrike. You can see the move in here from, let me bring this in a little bit, make it a little bigger. We don't need to see all the previous days. So we had a gap up on this day. And then, so this is all one day. It gapped up and then it pulled back. Let's go back and look at a 1 minute for the same thing, for the same day. Look what happened here. We gapped up. We pulled back. We closed right there. That is what I want to see. That's my entry signal. That is a patented signal for me, is pullbacks. I do not take breakouts. Go back and look at your charts, and you'll find most breakouts tend to fail. Not all of them. And I'm not saying you can't make money with breakouts. It doesn't work for me. For me, if I can get a breakout, the bulls took control. The bears said, and we get a pullback near, not necessarily to, but near support, and a close, ideally, near that support. And then we can bounce off there and get that $1 or $2 away from that support level. There's your entry. So we bounced off support, right? But we broke out. We closed near it. We failed. We broke out. We retested there and bounced. You either would have taken the trade right on this candle, or you waited to get this close here and this bounce to take it there. Either one works. All right. But you wound up in this trade at 443.5, 444. Right, which I think is what we said before, 444, right? We had a great run. Remember I said I may not necessarily wait till the end of the day? We had a great run, and then it gave me a topping pattern and failed, and this was about where we would have pulled out of that trade yesterday. But if you held on to the end of your run saying, I want this to go to resistance, it made it right up there. And then it tested once. It broke out, and it failed. It broke out and failed again. It broke out and failed yet again. Right? But this 1 minute right here, the 1 minute candle, that's the entry. If we go back to a 5-minute candle on this, that was all within this range right here on this pullback and bounce. That's the entry, and that's the signal we're looking for in there. All right. So the setup is not complicated, but it does take practice. This is not something you will gain overnight. And I will leave you today with this. Fibonacci, part of the technical aspect of trading, but Fibonacci is a science. Until you learn it, then it becomes an art. And there are tweaks along the way where you're going to find a place you want to draw a fib and you're going to go, man, I'm just not seeing it there, but I think I can make it work here. And that's where you have to judge the analysis that you're doing and say, what is my risk profile now? Am I just making this stuff up? Or, have I seen this pattern happen before on Apple, CrowdStrike, Coinbase, whomever it is that you're trading? Have I seen this type of thing take place? And if the answer is yes, then you go for it, right? So with that, everybody, hopefully this was helpful for you. I'd love to get some feedback on what you thought of the setups in here today. And next week when we get back together, if you have some questions, comments about Fibonacci, I'd be more than happy to answer that. So with that, make it a profitable day. Stay focused on the quest to becoming a great trader. Keep crushing it. And remember, you're just one trade away. I will see you all at our next update, folks. Take care for now. Bye.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.